Okay, so thank you everyone for joining us here today. This is our August event where we're going to be talking about financing commercial deployments in climate in an age of uncertainty. We can use that term. This is I can't remember now which one this is, the 10th or 12th or whatever of these events. We've been running them since November of last year. We do this series monthly. Most of these events are virtual, although we do host in-person events, typically at the major climate weeks. So we have a private event this year at New York Climate Week, and then I imagine we'll do a public one at SF Climate Week next year. The point of this series is to empower climate entrepreneurs with very tactical knowledge around finance in climate. And so we bring together experts in the space, investors, entrepreneurs, CFOs, you name it, and we go pretty deep. And we try to get real candid and real spicy whenever possible. I am one of the two co-hosts today. Hannah Friedman is the other co-host. Hannah has been a co-organizer of all of these events for a long time, and I'll give her just a moment to speak. Maybe one thing that I will just say is that our goal with this is to really make sure that we answer your questions. So as we go through this event, please make sure to chime in the chat. You can drop your comments and questions there. We will respond to them either as part of the dialogue or in the chat itself. So don't be shy. Any question is a good question. And we'll get started. Hannah, do you want to give any opening remarks before we have our speakers introduce themselves?
You said it best, Dimitry. Hello to this room. So excited to have this panel together, and for all of you hundreds of faces joining us here. It's awesome. Most folks know me in this room, because Dimitry and I have been teaming up on this for almost a year now, which is so exciting. Wear a couple different hats, but I've been a venture capitalist by background. I'm a venture partner at Planeteer, and I spend an inordinate amount of time thinking about the first of a kind facility. I've worn hats at Mark One, and as a fractional CFO across half a dozen early stage and scaling first facility building companies. With that, I would like to have our speakers introduce themselves. Let's go clockwise around the way that I'm seeing it. We'll go Rob, Mary, Amir, and then Christina for introductions.
Sure. Thanks, Dimitry. Thanks, Hannah, for having us. Thanks, everybody, for being here. Really looking forward to this conversation. We got some really cool stories on this panel, so I don't know why you started with me, but I guess clockwise. Anyway, so I'm Rob Day. I'm one of the co-founding partners at a private equity firm called Spring Lane Capital. We try to address what we view as a missing middle for any climate solutions platform that is dependent upon rolling out actual physical assets. So it could be steel on wheels, it could be steel in the ground, but basically across energy, food, water, waste, transportation, we find the companies that are ready to start scaling out their deployments. And yet, one thing that I'm sure we'll get into is that mainstream infrastructure typically doesn't step in until you're pretty far along. And so we try to help fill that gap. And then the other hat I'm wearing at the moment is CEO of a startup. Speaking of steel on wheels, CEO of a startup called Spring Free EV. No relation, Spring Lane Capital, Spring Free, very confusing for everybody, including myself. But that's in the electric vehicle financing space for commercial fleets.
Rob, you actually teed that up so well for me to say like where we fit together. So my name is Mary. I'm a vice president at Aligned Climate Capital. We invest kind of across two strategies. We have an infrastructure team that does solar, battery storage, a little bit of EV fast charging assets. And then we have the venture team. And in venture, we invest in companies in clean energy, efficient, resilient infrastructure, electric transport, and sustainable land use, probably in that order in terms of our portfolio. But the interesting thing is we also are kind of trying to fill a similar gap of like companies that are either deploying or supporting the deployment of clean energy or decarbonizing more broadly infrastructure, but we're not investing in the projects on the venture side. we are investing in the parent companies, like the topcos. And our perspective is like, there's this gap between when venture funds don't think there's enough exciting tech risk, and infrastructure funds don't think it's sufficiently de-risked or scaled for them to be interested. So we kind of slot right in there, and therefore we see Rob and his team around a lot.
Thanks, Mary and Rob. Happy to follow you guys. And thank you, Dimitry and Hannah, for having me here. My name is Amir Kirkwood. I'm with the Justice Climate Fund. Justice Climate Fund was formed about 2 years ago to help mobilize capital to finance clean energy projects, largely in low-income, distressed, rural, and indigenous communities across the country. Our main avenue through which we do this is by working with community banks and community lenders to help them sort of accelerate the growth of clean energy lending as a part of their platform of activity. So it works perfectly because these community lenders are often either first line of lending, sometimes last source of lending in many communities. And so the ability to get them to become clean energy lenders is really vital and critical in a lot of the communities across the country. So we're out raising capital to do that. We're helping to deploy capital. We're helping to serve as effectively a little bit of a private bank model to a lot of these community lenders and helping them to understand also what does it take to be an effective underwriter of clean energy projects at a community level. So thanks, and looking forward to the conversation.
I think I will go ahead and round it out. Christina Dalton here, VP of Finance for Solar Holler. We are an EPC serving the Appalachian community. What that means is that we serve Ohio, West Virginia, and Kentucky. We have been around since 2013, but recently expanded within the last few years. Outside of offering purchase systems, we've expanded into offering leases back in 2023, and now we've expanded into offering PPAs as of 2024 after securing a multi-million-dollar financing agreement. So we are constantly growing, expanding, but our mission at the end of the day is to serve our communities who would otherwise not have access to clean energy, and do that in a way where those cost savings can be reinvested back into the communities. I appreciate you all having me here today.
Amazing. We had way too much fun in our speaker prep call, so I'm thrilled to get into it with everybody on the call today, but I'd be remiss if I didn't give Dimitry a chance to also say hello to this room and tell us a little bit about what he's up to.
Oh, yeah. I forgot to do my intro. Awesome. So I'm Dimitry Gershenson. I'm the co-founder and CEO of Enduring Planet. We do two things in the climate ecosystem. We provide flexible working capital financing, debt, to early stage climate companies. We've done about 80 transactions to date and working on many more. We lend against commercial contracts, government receivables, government grants, procurement contracts. So if you are selling to government or large corporates, we want to talk to you. And then we also provide fractional FinOps services to climate companies. So we handle accounting, modeling, dashboards, KPI reporting, you name it. Work with about 50 climate startups and SMBs today, and would love to add anyone in this room to that list. All right. Thank you, Hannah.
Sweet.
Easy to forget. All yours.
Happily. Amazing. I want to start with a bit of a level setting, because we often talk about the kind of like copy and pasting of these projects as the kind of light at the end of the tunnel, right? That's what we're all working toward as we scale our stage companies, work with funders, EPCs, and community lenders along the way. Rob, Mary, banter with me for a minute. Let's talk about the fundamental differences between venture and first of a kind and how you underwrite those, and the difference then to repeatability of commercial deployments. How should the audience define and conceptualize those two?
Mary, you want to go first since I got the short straw on the intros?
Sure, I'm happy to. Okay, I think a lot of differences. And I think the easiest way to kind of bucket it from our perspective is like, as soon as we look at a company that is deploying assets, we immediately go into those assets and look at it from the perspective of like a traditional project finance provider, and understand like what is contracted, what is de-risked. And it's not just, I think a lot of times folks will think about like the offtake being contracted, and companies will be like, this is really exciting. We have, so and so wants to buy $100 million a year of our offtake, and they've signed this, and so on and so forth. And one of the biggest issues we have is actually rarely offtake, because usually something is being built because people want the offtake. It's the construction and scale up of it. And so I think a lot of venture investors are comfortable, and especially folk investors are comfortable taking a lot of that scale up risk. And sometimes in certain cases, we see that the company is actually taking that scale up risk, and you're, betting that the team has the engineering and, process engineering experience to build that up, or scientific experience. And in some cases, it's a function of like, we can get comfortable with folkish things if we think that, the EPC has fully wrapped the project, or somehow there's like sufficient risk transfer. So I think that's kind of how we conceptualize it. I'm curious, Rob, from the, actually looking at buying the assets perspective, how you think about it.
Yeah, we don't typically do first of a kinds. So venture capital, I think of as being useful. I mean, if you include more broadly growth in sort of the venture capital sort of corporate investment sphere. So I'm just lumping them together here. But that's a really important source of capital for the what we call topco itself, the company itself, not just up to the first of a kind project, the FOAK, but beyond, right? Because that kind of growth capital, then once they are actually producing something out of their facility, is still really important for growing sales force, et cetera. So I think it really, what you were getting at, Hannah, is thinking about sort of pre-revenue to ready to start generating revenue. Pre-revenue, I guess we're supposed to be spicy, so I'll just, use some shorthand here. But basically, a venture capital board pre-revenue tells their startup, move fast and break things. And we're dealing in the world of energy, food, water, transportation, et cetera. These things, can't break. These are very core essential services. These essential services are called essential because people need them, right? You can't afford to build something and then have it break, even if it's the FOAK, if you want to be able to scale your business past that. So I want to echo everything Mary just said. It's real smart, thinking about like, okay, well, when they're ready to transition to actually making stuff or producing stuff, what does that look like on the ground? Well, yeah, does the core technology work? We, like Mary, rarely find that that's, a major problem by the time we come along. Even for the FOAK, it's rarely a major issue. It's been demonstrated at the bench scale, pilot scale, maybe. The core technology works, but it's about, can you actually build a functional for-profit project? Because, it has to be for-profit to bring in that institutional Wall Street type, infrastructure capital, right? The first of a kind is usually about saying, okay, great, we want to make returns, but it's also about, like Mary was saying, can we build it on time, on budget? Do we know how to put these things together? And let me tell you, that's easier said than done, even if the technology works, even if there's an EPC standing behind it. We have seen, for instance, a recycling plant that was a first of a kind. It had been totally proven out at a slightly smaller scale, but it got defeated and massive cost overruns and time overruns because the pipes were slightly wrong diameter. And then they had to go, once they figured it out, and unwind it in massive amounts of delays. We've seen that in our own portfolio in a waste gasification plant where the core technology is working great, but it was really attached to it just some off-the-shelf dehumidifiers that had bedeviled the entire project, right? So the first of a kind is really proving, can you actually put together all of these systems around it so that you can have a functioning project? And the pathway to discovering whether that's true or not often means that you bleed so much in terms of time and cost that the first of a kind just doesn't produce the returns you're seeking. And you know what? Steel in the ground can only produce so much return at the end of the day. So we find personally at our firm that it's really hard to make good risk-adjusted returns off of that first of a kind project. We step in at the second one. Generally speaking, we have done some FOAKs. And we're not, tied to only doing the second one. But I'll just tell you even the second one, you're transitioning from something that was built, I'm speaking loosely, but duct tape, baling wire, right? You cobbled together whatever EPC was willing to take on an FOAK with other stuff. Your offtake agreement is generally a mess because, yeah, maybe you have $100 million offtake agreement, but you're wearing all the risk because the buyer's like, well, if you can produce it, then we'll buy it. We're agreeing upon a price and a target volume, but we're not committing to buying the volumes, right? Or something like that. And so for plant number 2, all that should be locked in. It should be by this point, hey, we've shown we can make stuff. We've shown what the cost should be when we actually do this on purpose. And so now we're getting, take or pay type offtake agreements. Now we have an EPC who's experienced. Now we have much more rock solid cost and time budgets. That's generally when we'll step in. And yet, even then, the joke is that the mainstream infrastructure firms will race to be the 10th to do something. So that's really the gap that we see.
And I think I just want to
Okay.
add something. In my defense in advance, I will say they said it's okay to sound like a villain, so I might do that. But I think the challenging thing is like when I think this was positioned, if I remember correctly, as like venture and folk or scalable. And I would say those are 3 separate things, or maybe venture sits somewhere between them. Sometimes there can be either. I would say most venture funds don't do folk. Like we don't really do folk. We will do first deployments of things that are really not first of a kind, in terms of like basing our entire investment thesis in a company and them being able to deploy. But I think the
Can you give an
big
example of that? Sorry to cut your thread there, but like when you say we don't do first of a kind, what would you do that's kind of like still first in a way?
excellent question. So the kind of like the core piece of this is like we do not want there to be a $50 million CapEx facility that we as a venture fund that put in $5 million are trying to like scramble and backstop a company to give them enough cash to get it complete or manage the cost overruns, because cost overruns can be massive.
Yeah.
So one, smaller assets are easier for folk. 2, there's a difference between like we're really doing something for the first time. Like we have, these 15 different machines that are doing heat processes and separation processes and like all of these whatever, and we're going to put them together
Oh,
versus being like, what was that?
you froze for a second, but you're back.
Oh, sorry. So like something more complicated, like, 15 different pieces of equipment that have really never been combined versus somebody that's like, hey, this technology works it's in this application. Nobody's ever really applied it to this thing, but fundamentally it works for that thing. It's relatively small CapEx per deployment. Customers want it, and we've done a pilot, and there's just not a lot. Like there's just so much less that can go wrong. It's a very fuzzy line, but that's the kind of thing that on the aligned like venture side we can do, because we are not a team of engineers and nobody on our team has ever been in any deep tech type of role. And there are venture funds that will do it, but I think the challenge, and Rob I think alluded to this, is that like if you are going to take a bet on a folk technology and a company that's deploying a folk technology, you really need to believe that there is a lot of juice and upside there for you. Presumably, you're making a portfolio of a number of those bets. And because that means that the asset, like the project itself, needs to yield something that even these early asset investors or project financiers can get an attractive, higher yield on it. And there's still going to be something left over for you. And it's really tough to get there. Like you have to be a really, really experienced folk investor or really deep in that specific market to be able to do that.
Yeah. I super appreciate this conversation and thanks for helping us level set. Agreed. Venture, folk, and then the repeatability of it. If I might paint a metaphor, a little bit what I'm hearing is like the bone of it is the technical part that's been de-risked. And sometimes, you got your, oh gosh, back to my anatomy days, you've got like the small bones in your arms and a humerus here, but like the real ability to get to commercial deployment, commercial repeatability is like the muscle of the and the ligaments that make them work together again and again and again to keep lifting the weight of the project. And like you said, Mary, it's got to be a heavy enough weight that like the juice of it is worth the squeeze. I let's take that, like, once the muscles have been built through the first projects, let's talk a little bit about what's happening in the market right now. We know that like examples of repeatability, commercial deployments in solar, renewables, batteries, even some elements of waste management have been demonstrated, right? Let's talk about how we get there. And I'm going to turn it to Dimitry in just a moment to talk about this market in particular. But Mary, Rob, when you look across the investment landscape, and Amir, maybe you have some thoughts here too. Are you seeing more volume from commercial deployments, repeatable projects, or are you seeing more from the risky, still lots of technical innovation going on? What's changed in your pipeline over the last 6 to 12 months?
It's gotten later stage. So look, we've been through a crazy last few years in these sectors. We went through a wave of SPACs where, just by the, don't want to derail us on this, but just trust me when I say, based upon the math of how SPACs work, you have to have astronomical valuations and huge checks. And so what do you do with a huge check that you didn't even need most of it of? Well, you can just throw it at steel in the ground. And then that, for a lot of other reasons, didn't work out very well. And so then stuff started to dry up. And then came the election season, and everybody was kind of pencils down with the uncertainty. And then the election turned out the way it is. And everybody stayed pencils down out of uncertainty. And then you would think that even with the passage of the OB3, as I call it, because I don't want to call it beautiful, that then you'd free up the uncertainty. And I think we are moving gradually towards all that, but they're still monkeying around so much and throwing so much, let's just say mud at stuff that it's still making people reticent to really dig in and write checks. And when I say people, I mean, our sort of peers in the infra world. And so what's happened is you've got companies, when you put all that together, that have been through like a year and a half or more without being able to raise the capital easily to go after this. So what I'm seeing, at least, and I'm curious, Mary, what you're seeing, but a lot of companies that are decidedly like ready to scale, that are well past folk, that need some kind of creative capital though for some purpose that they cannot get, that normally would have been in older times supplied through a large growth equity round and just do that awkward thing on balance sheet because at least then it's flexible. And now they can't raise that big growth round because those pencils are down and they're still not ready for mainstream infrastructure. Plus those pencils tend to be down. And so they're like, what do we do? Right. So just a lot of companies that are stymied and really poised for growth.
Yeah, 100% agree. I also think it's one of the things that's been interesting, there just weren't that many technologies from our perspective that were at that like sweet spot for us where the technology and the engineering is sufficiently de-risked, but they're kind of ready to start deploying. 4 years ago, there were kind of a relatively narrow subset of technologies. I think now it's like every few weeks we see something new emerge where we're like, that actually looks like it pencils. Whether we do it or not is a different question for a number of reasons, but like it can actually be deployed. I'm very curious. This is more of a question than anything value additive, but we've been hearing a lot from companies and to some extent from later stage infrastructure investors that had kind of planned to deploy a substantial amount of their portfolios into solar, especially but solar and batteries, that they're now like, we don't really think we're going to get enough volume at the returns we need. And so do you guys you think geothermal's ready for us? Do you think we can do some fuel cells, microgrids, waste heat to power, like all of these different assets, especially like in the energy space that they weren't touching before? So I think it's probably like two things, which is like more of these projects are ready for commercial scale and the investors are kind of being pushed to invest in other asset classes because they've already raised the capital.
I guess I'd add probably from the other side of it, because we're dealing with essentially credit and largely credit through relatively conservative institutions, right? They're depositories, they're highly regulated. we took an approach over the journey from when the GGRF came under, basically, termination to now, of like on a monthly basis going back to all of our lenders. And this is about a network of 400 or so lenders, and saying, okay, we know you had an idea of what you wanted to do, obviously under a subsidized world. And in a non-subsidized world, what does that look like? And originally under a subsidized world, it was about a $9 billion portfolio, probably roughly 2/3 energy generation and storage, 1/3 net zero emissions buildings. And every month we went back to them and said, okay, what does it look like now? That 9 billion is roughly 1 billion. And that in and of itself was a bit of a surprise to us. But we then went back the next month and checked and said, okay, is that billion holding? And it was holding. Went back and checked again, is that billion holding? It's kind of growing. Went back and checked the next month, and that billion was starting to grow. And we discovered a few things that really were driving that growth. One is that the typical customer, there was no need for technological innovation here in terms of products. It's like, can you get a heat pump in my building? Can I get like a microgrid going? Can I get, solar panels going? Usually under 2 kilowatts in terms of the solar capacity. So these are things that, these are proven things. It's actually just getting them to a specific market. And that was where the gap in subsidy financing was really critical. But what the banks are now doing are adjusting. They're saying, wait a minute, okay, I'm living with the fact that that's going away. I'm getting a better sense on where interest rates are in the market. Now I can go back and have a conversation with that customer, and the customer is still holding. So, that's really been what to me has been kind of the landscape of what we've been seeing along the way. And so it doesn't speak to innovation or venture, but it does sort of speak to the other side of the trade, which is, how do we commoditize this whole thing?
Yeah, I think this is a good time to shift a little bit and talk about, and I think I want to build off this narrative, Amir, around how lenders are adapting to this new reality. I think there's obviously a lot of things changing in the market today, right? So the federal support, in some states there's less state support, and in other states there's more state support, trying to sort of compensate for what's going on at the federal level. And so I'd love to hear, maybe we could just do a quick round robin. Christina, starting with you, since you raise capital all day for projects. Like, in 30 seconds, how are you seeing the market look today? Is it harder to raise money? Is it more expensive? Are you seeing new terms pop up that maybe weren't there before? People trying to mitigate risk in new ways? Are there elements of the capital stack you're seeing kind of evaporate or appear in this market? And there are also some questions around sort of insurance products and performance bonds that I think we can layer into this dialogue. Maybe we'll just do quick round robin, and then I'll come back to folks with detailed questions.
Sure, I can go ahead and start. So from an EPC perspective, we are seeing obviously more risk management options within the term sheet. From an interest rate perspective, historically, we had been able to get a little bit of a lesser market rate interest on some of our capital. Now it seems like it's more of the going rate with everyone that we've talked with. When we talk about, what's in the collateral package, what type of covenants, we've seen those type of things increase or expand on the term sheet. Those are things that we're constantly looking at. Again, from a risk management perspective, a lot of our capital providers want predictability. The scenario planning, the 3 to 5 year annual projections, wanting us to really clarify and walk them through, okay, if X happens, how do you all plan on mitigating that? Just making them feel a little bit more comfortable given the volatility in the marketplace. So, in a lot of ways, it forces us to be more, resilient and to build smarter transactions and, transactions that make sense, that will provide that investment back into the community. But, across the board, we're seeing more reporting, more, type of financial predictability that we need to demonstrate to make them more comfortable with investing in us moving forward.
Cool. Yeah, and Christina, just want to flag, maybe you as an EPC have some thoughts on this chat thread around performance bond and insurance, if you want to chime in there. Amir, Mary, Rob, do you guys want to say anything about what you're seeing sort of at a very high level in the market today in terms of shifting expectations or terms, and then we can dive in on the specifics?
I don't know if it's because capital is just less available to the investors, and I could be wrong, but it does feel like nobody is, probably rightfully so, taking the leaps of faith that they might have previously. Just want things a lot more locked down. And it probably is a function of kind of the fundraising environment where it's like, if you don't know how good fundraising is going to look at the end of your fund, you're going to be extra careful deploying your capital, and extra, down the fairway to the narrative that you need to tell when you're fundraising.
Yeah, I think this is actually a dynamic that it's funny. We often talk about the founder or the entrepreneur experience, and we forget to talk about the fact that fund managers and institutional investors also have to raise their own capital to deploy. And if there's an overall capital market slowdown, it kind of trickles through the entire ecosystem, and everybody becomes sort of tighter with their purse strings. And that dynamic is important because oftentimes I think founders feel like it's like, why are you 6 months ago when I talked to you, you didn't care about this thing. Why do you care about this thing now? And it's because their investors are like, you should care about this thing now. Otherwise, we're not going to give you more.
Yeah, I'd say on the credit side, what we've seen is it's 6 months ago when there was a whole lot of federal subsidy, more clarity on tax credits, on and on. The idea of raising a fund was a lot easier, credit fund. What's happening now is there's less interest in supporting a fund and more interest in just financing deals individually. So the credit appetite is still there, but to your point about certainty, lenders just feel more certain about what they can put their hands on versus another intermediary in the mix.
Yeah. Rob, anything you want to add before we dive deeper?
Just that I have seen more companies, like I said, really need both corporate capital and project capital at the same time, whether that's credit, like Amir was talking about, or project equity, or both. Because what people conveniently forget at times is that you rarely get your project, especially an early project, funded 100% with debt. So you still need to put equity in, right? And the
Even
equity,
your 10th project.
yeah, even your 10th one, right? I mean,
Yeah.
who does 100% LTV loan to value
Yeah.
and so you've got, whether that comes off your own balance sheet as sponsor equity or whether it's third party equity, you still got to raise it. And so just the desperate need to do both at the same time, I think really holds back stuff too, because as Amir was saying, people are looking at individual projects, but they care about the health of the platform that's deploying the project. So when have you raised capital recently? How's your balance sheet look? Not so good, right? Well, then I don't want to back your project either, and vice versa. So I think that's one of the things is I have seen more creativity around how can we support both at the same time.
Rob, can I
Yeah. Oh, go ahead,
press,
Hannah.
if I can interrupt, Dimitry?
Please.
Can I press a little bit there? Like when you think about as companies are scaling and like heat pumps are a great example, the microgrids are a great example, maybe even geothermal has its place here. When we think about some of these technologies that are especially being proven on a distributed scale, and we're thinking about like folks who are looking across asset level investing and topco level investing and the cash flows and exits required for each. Can you talk a little bit about like how are folks prioritizing the blend of return across those, especially when SPAC markets are no longer letting us go to the moon with topco valuations? Like what about those different levels of prioritization are you seeing from the investor side today?
I'll attempt to answer your question while also dodging it a little bit.
Sure.
So, and then I have a question for another panelist too, that's what it brings to mind.
Great.
But Yeah, so basically what we've seen is that when you try to blend everything together, it actually kind of messes things up quite often. Look, steel in the ground is my sort of shorthand way of describing actual physical projects and devices and stuff. You rarely make more than mid-20s at best type returns on those types of things. It's just for a whole host of reasons. The world isn't going to let you build a factory and then pay for that factory in your first year very often. In fact, what we see most often is IRRs, even for really exciting stuff for us. Like we're targeting like mid-teens base case IRRs ourselves when we work with a company. And that's on the project side. That's levered with debt in there. So to try to figure out then how that matches up with venture capital. Look, even growth equity is looking for a 5x in 5 years type of return. If you do the math on that, that's roughly like a 35% return. Then you realize that most of the capital going in, if you're trying to do it on a blended basis, is actually whether you structured it as growth equity doesn't matter. Most of it is going into those assets that are returning mid-teens. So you basically got to transmogrify, to borrow from Calvin and Hobbes, your mid-teens project into creating a 10 bagger, a 10x at the corporate level for that to blend together successfully. So what I am seeing, this is my dodge, but also a bit of my answer is, it's just smarter to think about that separately in many cases. Even if it is going to be just one check from a group, like we'll do one big corporate check, but quite oftentimes what we'll do instead is we'll say, okay, well, we'll put a check into your growth round and we'll put like a mezz financing into the company so that you can still have your asset on balance sheet. But for us, it's two separate investments that are obviously tied together, trying to make 1 + 1 = 3. So hopefully that kind of answers that question. But also, I did want to ask, like Christina in particular, it's because one of the things that really brings out Hannah as well is, what are the expectations out there? And I think there's always a mismatch out there. This is actually a great conversation that sort of goes against what I'm about to say, but so many of these conversations, it's all geared around like technological innovation, technological innovation, technological innovation, and yet, like Solar Holler is doing, it's a market innovation, right? And I'm just curious, how Christina's seen that conversation change with investors over time, because that honestly, over 20+ years, is something that I've seen wax and wane, where investors are like, I want a business model innovation, not a hard tech innovation, because that's easier. And then they're like, I can't make any money off of that. So I want to do hard tech innovation. We're going to build fusion reactors that fit in the backpacks or whatever, right? And as a pendulum swings back and forth. And yet a lot of the stuff that just makes sense are these smaller distributed projects using off the shelf stuff. So that's why I wanted to ask Christina that.
Yeah, so we've started PPAs probably the fall of 2024. A lot of our equity investors have been local to Appalachia. Again, they believe in the mission. They're excited for what we do and what we offer with PPAs, being able to deploy solar on school systems, churches, nonprofits. So I think, it's yes, we have a hurdle rate that we have to hit, but given the mission that we do, it's probably not as high if it's one of our investors that are really invested in our mission. But to your point, it's a juggling act between our capital stack. We have our equity, we have our debt, and then we have what we sponsor as part of the project. I mean, you have to meet the needs of all of the parties within the transaction. But I do think we're starting to see, again, given the market, we're starting to see that hurdle rate increase a little bit relative to the marketplace. So that's something that we're constantly taking into account whenever we're drafting up these financing transactions to make sure that it makes sense for Solar Holler too. But I do think, now we're seeing the hurdle rates increase a little bit more. But yeah, we've seen those bounce up and down a little bit too recently.
Would you mind defining that for this room? What do you mean by the hurdle rate?
So yeah, just the IRR, similar to what Rob had been talking about, whether it's a single investor, whether it's a fund, they're targeting a certain level of IRR back from the project. And that's something that we always have to, of course, take into consideration when we're looking at the overall capital stack of the project.
And I think maybe one thing that's worth flagging here is that oftentimes people think that, well, lots of folks don't understand the cost of capital in markets, period. But the ones that sometimes do, they think about it in the context of like the federal rate, right? So they're like, oh, the federal rate is flat, so pricing will stay flat. But that's not the reality of the market, because people are pricing in additional risk. And because of what's going on in the space, capital is getting more constrained and also more expensive. And it's also a supply and demand problem. The less capital there is, the more expensive it gets, because we exist in capitalism and capitalists are going to extract value where they can, right? And so I think that like one of the things that we often see is that people have not yet adapted their internal math to the reality of this new market. And also when they go to raise, they're like, oh, I want debt at, I don't know, 10%. And it's like, dude, that 10% debt hasn't been available to you in years. I don't know what you're talking about. And we've actually seen this where we've had folks that we've reached out to and we're like, hey, we want to give you a loan. We love these projects that you're building. Can we please give you money? And they're like, oh, your money is too expensive, too expensive. And then they come back like 6 months later and they're like, yeah, so we talked to everybody else and it turns out that actually your money's pretty cheap. So can we do a deal now? Like, we tried to tell you that 6 months ago. And so I think this conversation's really important. I also, Amir, I want to come back to you, because one of the things that changes the effective rate or the effective cost in a project or a development or whatever is the role of catalytic money, right? And catalytic money can be in the form of, hopefully the GGRF eventually, when that money gets unfrozen. It can be in the form of a loan guarantee. It can be in the form of philanthropic funding coming from a foundation. It can be state funding. Like there's lots of ways that people can stack money. And so, but obviously today is very different than a year ago in terms of the availability of this kind of capital. And so what are you seeing from, let's put the federal government aside, because I don't think we can hold out hope for them to do anything material in this space. Although there are, and this is probably worth flagging for everyone here, is there are still grants and pools of money coming out of the federal government for climate, right? Despite what the administration says, like literally every single day, we're seeing new grants, new support for the development of critical minerals, resiliency. It happens, but obviously the volume is so much smaller. So Amir, what are you seeing in terms of the rest of the world? Are folks stepping up? Are they sitting on their hands and saying, well, we want to wait and see till the federal government shakes out? Like, what are you experiencing in the market?
I would say that the general theme has been pretty challenging. I would say there are probably 2 or 3 factors. Factor number one is folks really were building their business models around federal support over the last 3 to 4 years. And it really did. If you're a foundation head and you're a CIO, you had given an allocation of your MRI portfolio for clean energy, and it's still assumed that there was federal funding in play. Well, that federal funding goes away, so you got to go back to the CIO and reset the expectations. So that's a big part of it. Another one is, and I think somebody just put this in the chat, tariffs. That actually really has impacted not just the supply of goods, but also the underlying pricing model. So I'm sure Christina could talk about that, the impact on just any deal that's in the market and the adjustment in pricing. In our current portfolio, the $1 billion I spoke about earlier, what we've estimated is across category, across lender type, the average subsidy cost on a deal right now is right around 14% gap that needs to be subsidized with some sort of concessionary funding. And again, it depends upon obviously what type and what geography, all that plays into it. But that still speaks to a significant amount of funding that is needed in order to bring projects to market. So where are we looking? Number one, we're looking to a lot of family offices and donor advised funds and we're not the easiest folks in the world to deal with for a lot of reasons, but
Or find.
well, right, or fine. But the argument to them, and this is really unique to us on the lending side, is if I can show you $1 billion of loans, roughly 800 projects diversified across all 10 EPA districts, that's a pretty low risk position for you to take on. And I can show you that there's a bunch of community lenders who are taking on anywhere from 50 to 80% of the risk. So your risk is always with someone else who's regulated, certified, whomever, with skin in the game. And so the argument is to go to them and say, is there a point you're willing to shave off in order to get to this execution because you have a mission orientation? And I'm doing all the work of basically getting you a risk mitigant partner to get there. So it's starting to have some impact. I think the area where it is most helpful is a lot of bridge lending, because that's really where a lot of the stall is right now in the project pipelines. The second area is credit enhancement against construction lending. Community lenders are great. They're completely mission oriented, but they are also equity light. They compete very hard for the deposit base. So the idea of bringing some credit enhancement in on a transaction would be valuable also. So that's what we've really been arguing. The other thing that is often thrown out there is the need for secondary market. I don't know how that gets there very easily, because there's just too much, or there's a lack of data, I think, that supports that there's, a commoditized way of looking at a lot of these markets. And particularly when you cover what Justice Climate Fund is looking at, the purpose was not to create a commoditized market. The purpose was to go and do the stuff that does not look commoditized, because that's where it matters the most in the community. So that's just a little bit of the landscape we're seeing and why subsidy is important. And, again, at 14% on average, that's significant enough, right, that you got to sell an investor on some concession on their rate.
The other thing which I would just throw in there, and I totally agree with everything. I mean, that was good stuff. The other thing I would also throw in there is, for those of us with longer memories, we remember the early days of solar where it was chasing state by state, the incentive programs. And you can absolutely go find, especially more, let's say entrepreneurial investors, even if they're not concessionary out of mission-oriented investors, but go find family offices and the like, who aren't huge check writers who need to, feel like they're funding a nationwide expansion. But instead, you're like, look, it's really juicy right now to go supply rideshare electric vehicles to drivers in Massachusetts. Yeah, it's only an $8 million allocation. Nobody's used it yet. Like, give us the funding that allows us to go take advantage of that. And so you can absolutely still trigger the greed gene for folks if they feel like they're getting special access to a pool of capital. And those absolutely exist at the local level, the state and local level.
Can I, this actually, oh yeah, go ahead, please.
I was just going to add a point of what Rob just said about the state and local level. Honestly, one of the things that we have been really doing that just really sounds scary, but it's really real, is we've been talking to investors locally also just to say, it is not just about climate. The cluster of things that is going around is affecting everything. So you cannot look at, when we're asking to look at an investment in putting heat pumps in homes, it's not just about the classic energy reduction cost argument you make. It's also the fact that the state budgets are about to get blown out. The pension funds are about to get blown out, because they're now going to have local FEMAs, and they're going to have to assume SNAP costs that were uniformly covered by the federal government. And they're going to have to assume costs around healthcare that were formerly assumed by the federal government. So it's going back to these investors and saying, we've been asking you to give concessions for a while because, hey, it made my project work. But we're also trying to appeal a little bit to just take a look at what the reality locally really is now under the current regime and what it will look like a year from now, and start thinking about climate as a part of an overall strategy to frankly help save some of these communities that and local governments and their budgets that are going to really have to face a different level of stress than they face today.
Yeah, I think this is ties into the like, kind of last question I wanted to ask before I hand it over to Hannah. And this wasn't in our notes, but it came to me as I hear you guys talk about it. It feels like, you know, historically, the message that I give founders is when you're talking about commercial deployments, when you're talking about infrastructure investment, oftentimes really what matters are the numbers, right? You're going to go to an investor, you're going to give them your data room and your memo, and you're going to say, hey, here you go, knock yourself out. If you like it, you like it. If you don't, you don't. But it feels like now storytelling is becoming important even in those levels, right? And I'm curious if you're seeing that across the board. Is it that narrative actually is starting to sway people even in these infrastructure sectors, and that broader message matters, or are people still really focused on just the numbers?
If you're asking me, I would say just the numbers, to be
Okay.
honest with you.
Funny,
I come
'cause-
from a world where we invest a whole heck of a lot of time on storytelling in the community development sector. I mean, we do storytelling, you know, from the time we wake up to the time we go to bed. And at the end of the day, treasury rates are what? And what's the spread over treasury rate?
Okay.
Yeah, that's what I was basically going to say, but also ironically, because we've been as a firm at Spring Lane, really trying to invest into stuff that's not commoditized yet. It's always storytelling for those companies anyway, because there just isn't sort of a ready like, okay, well, here's the numbers. Well, what do these numbers even mean? Is quite often the reaction, right? So it has
Okay.
Let's double click on that as we transition to a little bit about like capital sources and structures, recognizing this kind of market shift. Amir, you talked a lot about the need for concessionary capital. When you think about that storytelling, like how do you position projects that solidify a story of durability and not one of distortion with any different incentives? And then Rob and Christina, I'm going to come to you both on kind of regionally specific development needs.
Yeah, I think number one, what we try to do is emphasize the risk associated with the project on day one and really try to present it such that they fully understand that most of these projects have, first off, the technology is proven in most cases. It's a heat pump or it's a solar panel. So you start with getting them to understand the baseline of what's happening. It is a very stable improvement. Secondly, you have to remind them what the improvement is ultimately tied to. So while a solar panel is not in a loan tied to the real estate, I mean, if it's 100% occupied real estate project, how is the solar panel going to take down the property at the end of the day? So it's like getting them back to sort of the basics of the project stability itself. And then you can move to the subsidy question, because then you can turn it into just math. And it's just now, at the end of the day, this project just needs this subsidy in order to move it forward. But if you look out based on the stability of the asset, the savings created as a result of the improvement, and frankly, the long-term outlook on that commercial market, that residential market, whatever it is, you're really just arguing, you're filling a gap that is mostly a function of the fact that there is a delta always existing between perception of risk and reality of risk. And if I can get it to that level, then I got a fighting chance.
Maybe I'm switching it up here because that was such a spot on comment there, Mir. Thank you. Mary, when you think about what's happening right now in venture underwriting, especially when in some of your more deployment-oriented aspects, you're really focused on the repeatability here in battery storage and EV charging and things that had a lot of incentives that are now actively being demonized. When you're underwriting today and looking with the venture company kind of out across multiple phases of growth, do you only underwrite, or are you seeing most of the venture community look at incentives and subsidies as like the kind of gravy on top? And how do investors, maybe Rob can banter with you a bit here, but like how are investors thinking about okay, it's economical at like 12% IRR without any incentives, but actually it gets up into like 18 and interesting with the incentives. How does that kind of very fine line of incentives make or break different deals for you guys?
Yeah, I mean, I think it varies fund to fund. I think you hit the nail on the head. Like some of these companies that we invested in the earlier, earlier funds, earlier days, actually still like I flat out, this is bad energy policy, don't agree with it. Some of these companies are actually like still pretty attractive without the incentives. It's not great. It's definitely going to slow down the deployment. I think I said this a couple of times, not here, but just in general, like one of the places we're seeing folks really get slammed is where, the asset acquirers, let's say the asset was already, at the asset level before paying a dev fee, yielding 20%, and the asset acquirer wants 13%. The developer is getting a pretty juicy dev fee. And we're seeing some of those dev fees come down from, we're seeing some for solar, like $1.80 a watt down to 30 cents a watt, 40 cents a watt, where it's like, yeah, not the same incentive, much less cash flowing, but like still works. It's challenging, and there's going to be more kind of like roll-ups and consolidations, but I just want to flag that up front that like not all of these businesses, even though they are being demonized, you're right, like they don't all rely on these incentives as much as we kind of were afraid, and we're seeing a little bit of that pan out. And of course, some companies are absolutely devastated. So that's horrible. I think as we look forward and kind of for the last probably like year and a half, 2 years to be fair, like it's been pretty clear that some of these incentives are on pretty rocky ground. And so a lot of things we've looked at from the perspective of like, okay, even if these exact projects or these types of deployments don't work, um, if the incentives are pulled away, like how could this company pivot? Like what would this technology be used for alternatively, and kind of underwriting to that. Um, and some of them, the incentives have stuck around point source carbon capture, for example, and those are pretty attractive. I do think most investors are probably reasonably so over adjusting and saying like any company that has incentives, like they're reliant on it and they're going to assume that's part of their business and they're not going to, invest in them. I think a lot of companies are very quickly pivoting to being like, oh, by the way, yeah, that's like some upside we have, but you don't really need to worry about that. And it is impacting valuations because when you show investors a model that says, we might have these really attractive economics, but that all of a sudden becomes your growth case. When you think about, what if this program runs out or this state stops incentivizing this or you get this regulatory ruling. So I think if anything, maybe like a bit of an over adjustment right now, but that is definitely not an endorsement to wait to raise because it doesn't mean it's going to get better.
Heard. Rob, would you say that like in some of the private equity or more infrastructure level markets, like are folks just tightening their belts and willing to make the more consistent 12% returns, or are they getting pickier about finding the geographic specific markets where they can still hold out for higher kind of alpha there?
So I think when you're asking about that, I think it's important to just talk about what we mean by geographic markets. I'm assuming most of this conversation is related to the US, just given the panelists. And so I think one of the things that is not great is seeing how many European limited partners, basically the people who give private equity firms the money to invest, how many of them are now saying behind closed doors, like, well, maybe we dial back how much we put into the US. It's really not great. But I actually do want to sound a voice of optimism here a bit, right? One of the sort of misperceptions out there is that a project returns a certain amount of money regardless of how it's structured, right? And what do I mean by that? I get asked by people all the time, like, well, very sophisticated investors asking us, do you see like the returns on your projects going up or down in this market? And I'm like, I'm saying the same because we're still targeting the same returns. We're not an index fund. We're not trying to cover the whole market, right? We're just trying to find the ones that match our return hurdles, right? So the ones that we invest in still pencil out. And to push back a little bit on what Mary said, I actually do think things are going to be getting better. What people don't realize is if you're an infrastructure investor, you need certainty about what goes into your cells on your spreadsheet. You know, it could be, like a 25% returning project or a 20% returning project, depending upon your assumption. Those are both outstanding return scenarios. And yet, if you want to go to your investment committee and not look like an idiot, you don't want to say like, I don't know which one it is, right? And so just simply the uncertainty itself makes people go pencils down. We are now coming out of OB3, and I do think there's only so much, euphemistically described mud that they can throw at stuff. So I do think strongly that coming into 2026, even earlier, you're going to start to see the infra firms start opening up their checkbooks again. I think the style that they do it, and that's sort of the purpose of, I'm agreeing with everybody on the panel, that style is going to change a bit. Some of those sectoral targets may change a bit. But if you look at it, there is a record amount of dry powder that infra firms and private equity firms are sitting on right now. Much of it has been raised specifically to go after, however it's described, climate, renewables, impact, however you describe it, sustainability. Everybody knows there's this massive mega trend that's a global phenomenon that is a multi-decadal thing. These folks technically in charge at the moment aren't going to be in charge forever. And there's only, so long that they can stand in front of the flood of oncoming lower and better solutions, basically throwing mud at it to try to stop it. And so I firmly believe that where there's money, there's a way, and there's so much money that needs to be put to work that people are going to go find it. Now, what I do think is going to happen is you're going to see some sectoral shifts. Unfortunately, we are seeing now the next dip in the solar coaster, and you are seeing, Posigen is the latest one to basically go BK. You're going to see people make a sectoral shift like, well, I don't want to do solar at the moment. Sorry, Christina. But I do think you're going to see some people say, I want to do like waste to value instead, because that's less susceptible to, federal regulatory stuff, just as an example. But like Mary was saying, a lot of this stuff just makes sense now, even without the incentives. If you are building a commercial vehicle fleet from scratch, you should make it electric vehicles. Just full stop. Like, forget about any incentives. It's just cheaper. They last longer. They're easier to maintain. They're rolling computers. You can get a lot more other value out of it. The total cost of ownership, even without incentives, is a no-brainer for you to go electric. And that's just one example of where I think if I'm turning this into advice, like go out there and make your pitch be not, hey, we're saving the world, but this is just fundamentally a solution that people need, right? And I bet, and I would love to hear, from Amir and Christina, but I bet that's exactly how, when you're looking at, less sort of weird stuff like we invest into and more sort of established stuff, like they're doing. I bet that's exactly the pitch that works right now, even if it's a mission-oriented investor. Just like, hey, the world needs this, not because of the climate. Yeah, that too. But the world needs this because it's going to make money and it's going to help people have more resilient power supply and, reduce their electricity bill. Full stop.
I love the optimism. We could all use a bit more of that in our days. I think the other confluence of events happening right now is that in the mix-up, in the uncertainty of incentives, whether that's moving away from the federal government and into states in the US, but like you said, Rob, into other geographies as well. For the frustrating thing is that for a number of the first of a kind projects where they're going from that first deployment that would then help them lay the foundation for the nth and beyonds, in many cases, it's so obvious that the incentives for those projects are the ones that Mary referred to as like they're pretty sore out of luck in some ways, right? However, the other confluence here in a completely nonpartisan way has been the kind of demand for clean energy, especially from the large tech companies looking for the cheap, clean, green electron in a transmission and distribution system of our grid that is like not equipped to to help us get a commercial fleet of electric vehicles, even if it's just simply flat out the better product. And in so many segments, I work with companies in cement and concrete, where modular electrified kilns service cement deserts. I work with a number of e-fuels companies that are just making the fundamentally better base chemicals that are less toxic in their production, but they need clean electrons with those electrolysis cells. That need for, unfortunately, the cost structures of some of the price of that energy has just gone up for some of these deployments, trying to think about how they're going to be distributed in the future at a really interesting market moment, while likewise other incentives have been dissipating. I want to talk a bit about, therefore, how do you think about like sequencing as you reach into the nth deployment? So Christina, maybe we could chat about how you've done capital raises with Solar Hauler, with projects, and let's talk about mistakes that you would not want to repeat, or things that have come up in kind of risk mitigation for this market that you're kind of keeping a watchful eye on.
Yeah, definitely. So I would caution towards never forgetting about your working capital needs. So you have your operational side, you have your project financing side. What we ran into before is that, you know, we still have the daily grind, making sure we bring in enough capital to offset our operational needs, in addition to allocating our capacity to building out these PPAs and providing that return for investors. So, you know, when we talk about the sequencing, I would just caution everyone to really understand your working capital needs, because it's really about cash flow and the timing of that cash flow, the timing of your, you know, debt service payments, you know, your, reserve accounts, your interest accounts. But never lose sight on, you know, that nugget of what you need to bring in the door from a working capital standpoint, above and beyond the project financing aspect of your business, because we have historically ran into issues with that we've now corrected. But that all gets into the timing of these deployments and making sure it's something that works for the overall organization.
Awesome. Appreciate that. Anyone else from the panel have kind of the do's and don'ts of raising capital, sequencing, you know, parsing risk and return for various investors in the capital stack at the moment?
Never build a company based off of a high correlation with a government funding program.
Dimitry, any thoughts on that?
Yeah.
No comment. No comment. No, I think that it's interesting. I want to maybe temper that message a little bit, right? Because I don't think that it is always feasible to do so, right? I think in a perfect world, one would say, oh, I'm going to do this work. I won't take any concessionary money. I won't depend on rebates. I won't do any of this work. But the thing is, like, they're still there for now. And in some cases, in many cases, they will still be there tomorrow. And so I think maybe what I would revise or challenge or slightly disagree, and I would say you should just be prepared for multiple scenarios, right? Like, you as a founder, your job is to truly understand what happens in case A, B, C, D, and have a strategy for each. In the context of this conversation, the best way to do that is to have a good, either to know finance or to have a good team supporting you on this planning. This is not me like pitching Enduring Planet, although we'd love to build all your financial models for you, but like, you can go and model these things out. You can say, okay, if I build this project and I have this heat pump rebate, it will mean X return. If I don't, and I can just turn it off in the model, and like, now it means Y IRR. Or if I'm expecting to fund this research and development work with a grant from the federal government, what are my alternatives? Does that mean I have to raise more equity? Do I go slower? Do I finance this through this incentive program in a state? Like, there's all of these questions that I think founders need to just spend more time understanding, because if, to Amir's point, like, if you build your business around a program that tomorrow might be illegally terminated or even legally terminated,
Yeah.
That's not a way to be prepared.
Yeah, and that was more a little dark humor to help me
We
deal with
need
life.
we all
But I
need to
think,
laugh cry
yeah,
together.
I think your point is well taken. Like if I was talking about this with my staff earlier today, if you were to take the same proposition of Justice Climate Fund and all that we know about community lenders, all that we know about the project needs, all that we know about the impact that energy investment in low to moderate and indigenous communities could bring. The only difference would have been to probably start with a more diversified capital raise. I mean, that would be the only difference that I would sort of say would have happened. It was opportunistic to have a significant amount of federal funding available, but again, as I kind of started earlier, the actual project pipelines continue to grow. It's just trying to find the right mix of capital to get that pipeline, keep the pipeline moving.
Let's dig into those relationships and the kind of like tactics of getting that done right now. Maybe we could start with some examples. Like what are the projects in the pipeline that are moving most? Rob, when you talked about sectoral shifts and like waste to value being, you know, secular in today's market, like what are some of the things that you're all excited about or could share from recent portfolio fundings or projects you've successfully lent and built? Mary, why don't I volunteer you as tribute here?
Yeah. Man, this is so tough because it's just like it's such a broad question. Um, I think kind of if I'm understanding the question correctly, kind of tying this in a little bit to what Dimitry was just talking about, one of the one of the things we've seen that's like so important and such a predictor, maybe not on the first or second or third project, but like a company actually being able to scale, you know, to a full kind of infrastructure platform has been their ability to actually understand the value of their assets. And when you're looking at kind of like when you're looking at the solar universe, I think it's much more common for folks to have access to kind of like resources or folks that understand how to kind of like parse, you know, to the extent that policy and you know, local tariffs or something are needed to be parsed. There, you have access to the folks that can parse that. I think one of the big challenges we see is we'll have companies that have kind of like a semi-novel technology, or they need to have an understanding of, you know, policy as to their very niche type of project. And we see a lot of companies run into kind of like working capital, scalability issues there, financing issues. And it's usually not until like we kind of see a very clear like divide of the companies that kind of do get on top of this early on and the companies that already have gotten a pretty unfriendly term sheet that they don't understand is unfriendly for like asset financing or asset offtake or acquisitions. That then they kind of are like, wait, I thought my asset was worth, you know, I thought I could depreciate 100% in year zero for this type of asset, or I thought that, you know, I could claim I would get this tax benefit immediately and, you know, not next year or whatever it is. So I don't know if that really answers, but in terms of kind of like infrastructure scalability and kind of setting yourself up for success, that's how I think about it. Was that
Maybe
what
that's
you were getting at?
no, it's a helpful framing. Slightly what I was getting at, but also like where are some of the success stories coming in kind of different projects or sectors. If anyone has any initial reactions to that. Otherwise, Ashlyn is asking a great question from the chat as well.
I have one incremental thought on that.
Yeah.
It's we find that things that are maybe this is not individual naming companies unless you want me to pitch my book, which I'm happy to do. When we see companies that are deploying either like because we're kind of thinking about this like financing deployment and we're about this project focus, when we were finding projects that are call it $20 million of capex or of equity need for any given project, we find that those tend to be a little bit more successful in lining up early financing because they can go to these like kind of funkier one-off funds, and that tends to be distributed assets. So like, I know I've kind of shown my bias toward distributed assets during this call, but I'd say like a lot of the success stories we have, in our portfolio, I think uh, renewable microgrids, point source carbon capture, like those kind of things have been really successful, where we've seen these companies just be able to like iterate quickly because they're deploying projects relatively quickly, building pipeline relatively quickly, and deploying, raising capital, deploying quickly. But also, like, I think this applies to a ton of stuff. Like, we don't have a single waste heat to power company, geothermal for heating and cooling company. We don't really have much by way of like building energy efficiency, but there are a lot of the same characteristics there. I think that's where we're seeing most of the success at our, small check venture stage.
Christina, Amir, are you seeing similar dynamics in the projects that you are capitalizing and supporting?
I see nodding, but
Oh, sorry. Yeah, yes, my answer would be yes, seeing a lot of the same dynamics, actually.
Christina, I'd love to. I don't know if you want to take a shot at this question from in the chat, because I feel like as the kind of the primary EPC representative here, maybe you're already doing some of these things. Are you trying to sort of allocate more risk to project partners wherever possible, or having others allocate risk to you, or is it still sitting in kind of the same places?
Yeah, I would say when we were fresh to the market, we probably took on a little bit more risk than what we would normally take on, just because we wanted to get into that side of the business. We wanted to bring in those type of projects. But I do think now, we are looking at de-risking ourselves a little bit from an EPC perspective, and kind of, spreading the risk to some degree. I think the original focus was more so, providing for the needs of the equity partners and our debt facility financier. But again, we have also been forced from an EPC standpoint to kind of assess our own risk and look at ways that we can spread that a little bit more than what we've historically have done in the past. And I think there's a little bit of a willingness from what we've seen. We haven't always necessarily gotten our way with that, but I think there's some flexibility, just given the volatility and everything going on, with a little bit more flexibility to not have the EPC necessarily take on as much of the risk as we've historically taken on.
Yeah, I'll jump in on that too. Because I actually think it's not the right time to ask for flexibility, and in 6 months it will be. Right now, everybody's racing to get projects done because of the changing policy environment. EPCs have more business than they can, than they can manage. The projects are starting to dry up at the development phase already, which means in a few months, the EPCs who don't want to have to lay off staff of their own are going to be desperate to fill their own book of business. At which point then you can say, okay, well, look, this is, an exciting one for you to be jumping in on now, because we got this whole pipeline of projects behind it. And, you want to get in while the getting's good. And the way for you to do that is to help us raise money by taking on some of the risk yourself, right? And so I think now is a bad time to ask for a full wrap, as it's called. I think 6 months from now is going to be a great time to ask for a full wrap. Just to give one example, a full wrap basically means like the EPC has guaranteed, it's never a full guarantee, but basically guaranteed on time, on budget. And then that makes the investor happier writing a check. And so, yeah, I think timing is everything.
So would your advice, Rob, be to go develop a bunch of pipelines so you're in pole position for that negotiation in 6 to 8 months from now?
It's really hard to raise one project at a time. That's, Mary talked about loving distributed, distributed projects. I think everybody on the panel shares that same bias. um, but one of the answers there that worked 15, 20 years ago around solar, resi rooftop, and then community solar, was being able to say not like, "Hey, I've got this one homeowner. Will you finance this one homeowner?" But instead, I've got $20 million worth of homeowners. Would you finance that? And financing at a portfolio level is helpful. One of the things people don't realize is just how much an investor's check size dictates what they find interesting and what they don't. And there just aren't too many people out there who are institutional and have a $500 million infra fund and are willing to write six-figure checks at a time, right? They just can't. They can't manage that. And so, yeah, the answer is always, build your book of business, your forward book, and be able to talk to that when you go out there. Let me use that to give a little bit of other advice though too. If you're building that pipeline, try to make that pipeline look as standardized as possible. I've been approached by developers in the past who were just, very scrappy entrepreneurs, and nothing wrong with that. That's great, love it. But they were like, "Yeah, I've got like $100 million pipeline," and you look at it, it's like it's a battery project, it's a ground-mounted solar project, it's a it's what is it, right? It's this whole hodgepodge of different projects, and it just they're just more scrappy than focused on being scalable. I'm like, I can't back that. Sorry. Instead, it's like I want to, I know even for project number 2 that I'm backing of yours that it's going to be painful. There will be still things that we have to figure out, even for project number 2, and I'm going to take the pain on that. But I want to amortize that across then another like 6 identical or very close projects. So you really need to build your pipeline to look like that. The other piece of advice I would give here is. And this will be more applicable to some people in the audience than others, but learn how to think and talk like a project developer, even if you're not one. Learn how to talk and think like an EPC, even if you're not one. As Mary was talking about, like what looks like, hey, great, we've got a term sheet for financing may look actually terrible, or we may have a customer contract that like I was talking about earlier, that we think looks great, and we wave around with project finance, and they're like, that looks terrible, right? You need to learn to view the world through that lens, even if you have no intention yourself of ever becoming an actual project developer. But that's where the money is going to come from for your actual physical deployments. It's so bad out there. If you think about it, there's like 1,000 different venture accelerators that teach you how to be a venture-backed startup. As far as I can tell, there's like 2 programs that help you, with project development expertise and how to speak that. And one of them is ours, and it wasn't anything that we set up except out of necessity because it just wasn't anything out there in the universe. So I would plug for everybody. We've talked about family offices, we've talked about various things. Just one quick plug. The CREO network, CREO network, is an aggregation of family offices. So Mira was talking about family offices. That might be a good place to hit up for some capital. But even more importantly, CREO has taken over from Spring Lane Capital the managing of a program which we call Developer U, which is essentially like a 2 to 3 day seminar, outside speakers. No one's going to walk out of there being, hey, I've done 2 days of this, I'm an expert project developer now. But at least you now know what you don't know. And to what Christina, what Amira were saying, like, great. Now you need to now ahead of going to pitch infrastructure capital, I need a CFO who speaks infrastructure, right? I need this. I need to be thinking about my offtake agreements this way. And it's just vital to learn that very foreign language from how venture capital and venture-backed startups talk.
Not agree more.
Thanks, Rob. Linked as much as we could in the chat there. Dimitri, do we want to wrap it up with one rapid fire 4-minute question here?
Yeah, we would love everybody. I mean, Rob, I think, just gave a bunch of advice, so we're going to skip Rob this last section. But Christina, Amir, and Mary, maybe in that order, if you could give one piece of advice to founders in the audience around how they can navigate financing their commercial deployments today, what would it be? And if you can be spicy, extra spicy, that's even better.
So I would say, you know, deliver on your commitments. So, you know, when we talk about trust building, you know, it's a little bit difficult to get the first one, two, three potential raises, but with project deployments and, you know, hitting on those commitments, that's where you create trust and credibility. So it'll come a little bit easier to some degree whenever you've been able to demonstrate those historical successes. But again, the cheapest capital you can raise is credibility. So, you know, making sure you put those projections and those expectations out there that you can hit, because the last thing that you would want to do, obviously, is to fall short and have that impact future projects downstream.
Awesome.
If you would, sort of following on Christina's point about making an investment and commitment, not only make the investment and commitment, but bring 2 or 3 other investors along with you.
I think when you're thinking about scalability in your financing plan, don't, unless this is your expertise, like don't go at it alone. I think a lot of times it's easy for us to think like, you know, I'm a strong CTO, CEO, I can figure this out. This can't be that complicated. But so much of it is just kind of like industry intel that is in connections and knowledge of structures that like it's just not intuitive. So I do think it's really valuable, whether it's kind of like somebody full-time or somebody fractional or outsourced. That really did sound like I was doing a plug for Enduring Planet, but that was not the intent here. No, but I mean, like, really do it's worth spending the money to get your financing right.
Yeah. Awesome.
Asking, we have a minute left. Maybe I'll do this one to Christina and then to Rob really quickly. What's one of the grittiest trade-offs you've had to make in order to keep a project financeable? This could be cutting scope, this could be delaying hires, restructuring the debt, but like tell us something real.
I would say the project timelines, as far as how aggressive we could be. So again, getting back to one of the struggles when we talk about working capital, that's something when we initially got into it, we quickly learned that we needed to assess our working capital needs in conjunction with project financing. So we had to shift out a couple projects that we were building based on the timeline and our capacity to be able to take on those projects and still ensure that our operational side of the house was healthy. So those are some of the things that we've had to trade off, was delaying a couple projects to ensure that the overall organization was healthy from a financial perspective. But moving forward, you know, we now know that project timing and cash flow is of the utmost importance. So we haven't ran into any of those issues like we had when we originally started out.
That's good. I'll try to be really quick because I know we're at time. The grittiest thing that we've had to deal with as an investor is generally like the health of the developer midstream in developing a project. I think one of the reasons why we've had generally good relationships with our developers is because we don't expect perfection, unlike many of the bigger infra groups. You know, we know things are still going to have to be figured out. So being flexible with like milestone advances or something like that, we don't want to do that. But you know, project investing is, if you're doing it right, a constant exercise in choosing the least bad option in front of you. But I will say speaking of that, the grittiest move I've had to make is stepping in as CEO of one of our portfolio companies. So
That's grit in action, Rob. We love it.
Day to day, I'm feeling the grit right now.
He's walking the walk. Hey, thank you all so much for joining us. Thank you, Dimitry, for being the best partner in crime ever. This is a privilege. We'll share the recording with everyone who attended and summary notes. Thank you.
Those should go out, I would say, by end of next week to give Hannah and me some time to process. Thank you, everyone. And if you will we'll get you an invite to our next event as soon as it's posted, which will probably be around the end of September, early October, for like end of October kind of time. Looking forward to seeing folks again. Cheers.
Thanks a
Appreciate
lot.
y'all.